Can we talk about Disney? I know you're a huge fan of Disneyland. Your kid loves it. But the company is struggling as they just kicked out their CEO and are bringing back an old-time favorite, CEO Bob Iger. The stock is languishing near its COVID lows, which seems strange because all the articles I'm seeing seem to praise this move, with many seeing it as a course correction. Yet the stock, with the stock at these prices, the question really becomes, is it a buy?
Right. So let's talk about Disney. I'm pulling up the chart on my computer here. Yeah, so Disney is, it's languishing at those COVID lows. What I like, so Bob Iger is the man. He is a star. And he knows what needs to be done here to right correct the course of the ship, if you will. What happened is that Disney is really trying to build out its streaming section to become more of a technology company as opposed to a legacy company, and that's a smart move. Iger was a pioneer of that. Iger is very bullish on that, but the new CEO, now the old CEO, Bob Chapek, was much more on the fence about that and tried to balance everything, whereas Iger was like streaming. And so I think what you can expect when Iger comes back in control is that it's going to become a very streaming, once again, turn back into a very streaming first narrative. And when it was a streaming first narrative, the stock did very, very well. And I think the stock can do very well here. The valuation is really attractive on Disney stock. I think that you do have that travel bug going around. And so I think that Disneyland, Disney World, Disney parks everywhere are going to do very well. Disney also has some big exposure in China. And so if China does reopen in 2023, that should benefit its Chinese business. And then again, I think the consumer remains strong. So I think they're going to continue to sell a lot of toys, a lot of merchandise, a lot of all that stuff. And their movies, I think, are, they have the best content out there. So So I have no concerns about that. And on the streaming side of things, they got to spend to grow. And that's a strategy that has not been rewarded in 22 with rising interest rates. And falling interest rates should reward that strategy in 23. And so I think the Disney stock does look pretty attractive down here, $94, $93. Let's pull up the valuation on it because I'd love to look at where it is compared to its historical valuation levels. And when I look at its forward P multiple, it's trading at 23 times forward earnings, which seems pretty expensive. But this is a stock that is a growth stalwart. Like it's able to grow and grow. It's got great brand equity. It's got a great name. And so 23 times forward earnings for a name like that, it seems pretty strong, especially when I think those earnings estimates can move higher in 23 with China reopening and with, I think, better than expected streaming growth. So I like Disney stock. I like the setup for Disney stock here. I think it's an attractive setup. I think Iger knows exactly what he's doing. I would bet on Iger. I'd bet on the stock. I do like Disney at these levels.
So is the levels that we're seeing right now a result of what Chapek did, or a reaction to Iger coming back?
Neither really. No, it's a result of just the fact that, one, the international parks business has not been able to perform up to expectations because the consumer is weak everywhere else besides America. Two, the streaming business, which had this super fast hot start, has cooled off. And, when things cool off, investors cool off as well, and they start to sell the stock. And three, they're coming under a lot of cost pressure. So I think there's a multitude of fundamental factors which got the stock to these levels. The CEO had something to do with that, not everything. But the fact of the matter is Wall Street just has a lot of faith in Iger. And so they're willing to give a little bit more rope to the Iger-led Disney than to anybody else leading Disney. And so I think them giving a little bit of rope, plus I think a lot of those factors will turn around. I think the consumer globally does strengthen in 23. And I do think that cost pressures mitigate. And I also believe that the streaming business is now, again, a lot of these things had red hot growth, cooled off, and now they're going to normalize. Like the truth of the growth trend for a lot of streaming companies, for a lot of digital advertising companies, for a lot of e-commerce companies, the truth was in 2020, 2021. That was way too hot. And the truth was in 2022, that was way too low. It compensated, it overcompensated. So the truth is what 2023 will be. And I think it's going to be a much more normal, healthy, durable, sustainable growth rate. I think Disney Plus will get to that in 23, and that'll help the stock out. So the CEO switch up makes the headlines because people love talking about people, make good characters. But that's not why I would be buying the stock here. I mean, I think it's part of the bull thesis, but really the bull thesis here is that with Disney stock, you have a very strong asset with a long history of operating excellence, trading at a extremely discounted valuation, with major growth catalysts on the horizon in 2023. So you put all that in a bowl, and I think what comes out is a stock that moves meaningfully higher next year. So I do like Disney stock for 2023.
Thanks for watching HGI Clips. For the full episode, head on over to our sister channel at Hypergrowth Investing by clicking the link in the description, or listen to the podcast on any of your favorite streaming platforms. We make new episodes every Wednesday, so make sure to check it out and subscribe to never miss any of Luke's Hypergrowth insights.